Hey everyone, it's Imran from Options Insight with your macro options spotlight. All right, softer tone to finish off the month of October yesterday. We had some month-end selling. There's about 3 billion, I think, into the close in terms of net selling imbalance. We had a larger than expected issuance announcement from the US Treasury, and that kind of kept a bit of a lid on stocks and also on bonds and drove a bit of a dollar bounce. That does all seem to have faded overnight as we had rumors out of China, unconfirmed, but rumors out of China that they're considering easing zero COVID, setting up sort of some committee to talk about strategies to exit that policy. And that's ripped Chinese markets up. Hong Kong's up, 4 or 5%. The tech sector particularly leading the way there. So, maybe another false start. We've seen these rumors come and go time and time again. So I'm not exactly going to chase it. But that is what we're seeing overnight in terms of the risk on tone. Implied vol-wise, we did see vol bounce pretty much across the board, except for China, which was down a bit. Obviously, we've got a key FOMC meeting on Wednesday. We've got non-farm payrolls on Friday. These are all kind of bringing a little bit of a bid back towards vol. But vol is significantly down, right? If we look at on the week, vols are down heavy in stocks. Vols are down quite a bit in FX. Vols are down massively in bonds still on the week. So to see a little bit of a bounce back in vol is not surprising, given that we've got these very, very key catalysts this week. Carry-wise, continues to be sticky in terms of European stocks. They're really stuck. They're realizing 11 vol. They just can't seem to move right now. I'm not rushing out to sell a load of European gamma. I think FTSE Gamma was the best sale. I didn't manage to get the trade on. I had suggested it in the Daily Note a week or two ago. So those of you who managed to get that trade on, you probably did quite well. But basically, I'm kind of staying out of it for now and letting these catalysts play out. Not really looking to find theatre in that market right now. In terms of other places where there's positive carry, we see it in oil, gold, and HYG. Despite the spot weakness yesterday. And FX vols in general, you see a bunch of red saying that FX is moving more than it's implied. So I wouldn't be in a rush to go and sell a load of FX gamma right now, especially ahead of FOMC. All right, other than that, skew-wise, not a lot changing. Still seeing skew on the lows in terms of equities. It's pretty pumped still in China, but that's kind of understandable. We've got pretty neutral skew in oil as we've been flagging, as calls kind of catching a bit of a bid there. And then the only other thing to kind of note maybe is HYG skew starting to bounce off the lows. It did get whacked back down quite hard. We did see a 1.5 sigma down move in HYG yesterday, which I think kind of accelerated after that refunding announcement from the Treasury. So maybe there's something in that trade. So I kind of mentioned that on Friday's note, that I think leaning into that rally in HYG was not a bad idea. We used the rally to buy some puts back that we were short as part of a put spread. And we still like that idea that HYG is probably going to underperform eventually and is probably has less squeeze risk in it than equities do right now. All right, that's the summary. Okay, so moving on, what are we seeing? So big inflation data, inflation printing to a new high in Europe. 10.7 was the headline, keeping pressure firmly on the ECB to be aggressive on rates, and also keeping a bit of a floor under bond yields globally, right? That was partly, why bonds just kept going lower and lower and yields kept going higher, because that European inflation story was really a big driver. Recession's becoming obviously more likely, but with core inflation also rising, the job for the EU policymakers is becoming increasingly difficult. Obviously, they're facing stagflation that hasn't been seen since the 70s. And that's a pretty tough thing to deal with. One saving grace, perhaps, is that the winter so far has been warm and the gas tanks are pretty full. So the energy crisis seems to be on pause for now. And we've seen gas prices absolutely plummet in Europe, which is a good thing. But that doesn't mean the problem's resolved forever. And so there are still structural changes that need to be made to not be so dependent on energy from other people. Also, keeping bonds under pressure, as mentioned, was this announcement from the US Treasury, expected to issue another 550 billion in Q4, which was 150 billion more than expected. The initial reaction in yields was higher, knee-jerk higher, about 5 to 10 basis points in the 10-year. But since that is faded overnight with the risk on tone triggered by the Chinese rumors, and that's all faded back. The other chart I've got in here is just showing the Fed balance sheet and showing that we saw the biggest monthly drop in the Fed balance sheet since July 2020. And remember, that is just the beginning, right? If they're true to their word, there's a lot more of this draining of liquidity to come. And this is why we like being short things like HYG. All right. Now, if we have a look at Brazil. So Lula won the election over the weekend, and Brazilian markets liked it. So if we look at what kind of happened, the thing that had flagged this to us was after the first round. So on the first round, we had that big gap up in EWZ, and we had that with a volume spike. We've got the volume there. So with above average sort of volume, market was showing its hand that a Lula win could still be market friendly, even though he was a leftist. And we sort of thought that once the uncertainty of the election was out the way, we would potentially get another load of money rushing into the market. And there we go, another volume spike yesterday, and the market finished up 4% on the day. So we still like that trade. We still think more money is going to be sucked into that trade for a number of reasons. And we're going to talk about that. So we chose to buy longer dated calls in EWZ to express our bullish bias. And the reason we did that was because we didn't want to be exposed to a volatility reset post the election. So if you see, if we look at a week ago, what the curve looked like, that was the red curve. And post-election, we've seen that front end go from nearly 80 vol back down to 50. We've seen December options drop by a good nearly 10 vol points here. The front end dropped by 25. The December area dropped by about 8 to 10. And the back end, June, has done next to nothing. And that was the general idea. The idea was park ourselves in June, be in the trade, but be in a place where we're not going to get butchered in terms of being long volatility. Now, the outperformance of EWZ also, another reason to be in June and not just in the front end, wasn't just because of the election vol reset that we didn't want to be exposed to. It's also because if this EWZ trade does come good, then it will depend on, the currency as well, because EWZ is obviously a dollar-based ETF. So if the real strengthens and that thing goes up, if the stocks go up as well, that thing goes up. So it's kind of like what we call a composite exposure between the stocks and the FX in Brazil. So we think that has got potential to go. Dollar real has got the potential to go a lot lower, but that's going to take time. And that will certainly be helped by broad dollar weakness that we think won't really come until we get a pivot in Q1. So there's no point being in your Brazil long to December when you don't really think the Fed pivot's coming until a bit later down the line. And that's when you're really going to get a lot of juice in this trade, because you're going to see the dollar get smashed. And because of the high beta nature of things like the EM currencies, when the dollar does get smashed, that will probably be very good for EM, and it'll be good for the likes of EWZ. So we want to be in that trade out to the middle of next year, so that when that pivot does look more and more likely, then that thing's really going to catch a bid. So that's another reason why we're parked in that part of the curve. We are looking at oil stocks versus oil price. You can see here there's been a bit of a divergence between what USO is doing and what the likes of XLE and XOP are doing. This is something Tony Greer's been talking about, and that's why he's parked in the stocks rather than the actual underlying commodity. I personally think there is a potential for a catch-up trade here where the commodity could actually rally and the stocks don't rally as much. And the reason I say that is because we've got the midterm elections coming up next week. The incentive for Biden to be draining the hell out of the SPR goes away after the midterms. He's already started to move his attention towards oil companies and saying there should be windfall taxes because these guys are not reducing their prices. So I get the sense that he realizes there's not much more he can do on bringing the actual price of oil down. Okay. And he probably already knows that he's going to probably lessen the amount that he's draining from that reserve. There's no point in him doing it if he wants to have a strategic reserve. That's the whole point of it. It's strategic. He needs it longer term. But the idea is, if he does, the market doesn't really believe that these things are going to get passed and he's going to get these windfall taxes through. But just the noise and the rhetoric of that maybe could keep a bit of a lid on the stocks. Whereas I think we may get a bit of a catch up in the actual underlying assets. So for me, I'm looking for ways to get exposure to the long oil via the USO ETF. And that's the trade that I'm looking at. So that's it for today's video. Thanks a lot for listening. I'll catch you all tomorrow.